presentation contains current opinions of Moez Ansari, Chief Investment Officer of Compac Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone, and welcome to the Compac Market Wrap YouTube update for July the 7th, 2025. I'm Mo Ansari, President of Compac Asset Management and the Chief Investment Officer. Thank you for joining me today. Let's start with the markets. First of all, a quick reminder, click on the subscribe button so whenever I post an update, you'll be notified and you can watch it at your convenience. Looking at the numbers, S&P up 1.75% last week. Dow up 2.34, and the NASDAQ was up the least. I don't like that. I like NASDAQ to be 1, but we saw Dow 1, S&P 2, and NASDAQ 3. Usually I like 1, 2, 3, the opposite. Usually, so it seems like we're running out of a little bit of momentum on the upside. We had the big, beautiful bill was passed, and now I think, what is the next thing that's going to stimulate this market to the upside? Tax cuts, well, we did get a lot of tax cuts. We extended the tax cuts. That's the big, beautiful bill. We did get some tax cuts on no tips and on Social Security if you make less than $75,000. After that, it starts to phase out. And there's a number of other things. I'll talk about those a little bit on further YouTube updates and on the podcast as we go through the updates and the changes in the tax code. But not a lot. There will be some stimulus that is going to come from the bill in the first couple of years, and then it's going to sort of die down a little bit because then the cuts are going to kick in. So what is going to be the next thing? Everybody was excited that we might get an interest rate reduction this month at the FOMC at the Fed meeting. That is, I think, off the table now. We're not getting that interest rate cut. That's the way it looks. 80% probability the Fed is not going to do anything. So what is it? I think it's going to be earnings, and earnings have to really come in good to give us more impetus. But we have had a beautiful run in the market since April. We've gone up a lot. I think it's time to digest some of these gains. So we could see some sideways, backwards, choppy, up and down sort of market until we get some more clarity, until we get to the fall. So it could be a couple of months of back and forth, not particularly aggressive upside move. That's the way I'm looking at the markets today. Last week, materials was the best sector. Worst sector were communication services, which is Google and Meta. They were not down 0.1%, so not down a lot. Oil still now back up to about $68 a barrel, going up and down. Gold sort of going sideways. Everything sort of going sideways. The jump was in the bond market where interest rates went up from 4.9 to 4.35. That was a big move to the upside, but still in that range between 4% and 4.5%. Now we went down to the bottom of the range, went down to 4.2. Now we're back up to about 4.4 on the 10-year. That's going to be the driver, I think. That I don't think interest rates, unless they go above 4.8 on the 10-year or below 4% dramatically, that would indicate something is changing. But right now, and high yield did better last week than the bond market, where high yield was up 0.46 and the regular bonds were down 0.09. So high yields are bonds of companies that are not in a great financial picture. So if there's a chance of a recession or slowdown in the economy, those bonds go down a lot more. But right now, they're going up a lot more. So that's still okay. One thing that we've seen is a diversified portfolio. If you have that, you'll be okay. I talked about this quite a bit. Javed and I did on the podcast, so tune into that. And we talked about maximum drawdowns. But we did get the PMI just about around 50. JOLTS report, that is the job openings, that came out last week, showed that job openings are going up. And we saw the unemployment data. We saw 147,000 jobs created last month, more than the expected, and the month before was also revised up that more jobs were created. So the job market is going away. It's not sizzling hot, but it is doing okay, holding its own. Not a lot of economic data coming out this week. Technicals, we're looking at third wave top. Again, target was 63.5 to about 64.5. We got to close to 63, and now I think we're going to get a fourth wave back and forth before we go up to the fifth wave, which could take us up in the fall. Weekly charts getting closer to a 5, which I don't like. That usually shows a long-term pullback in the market. But again, support on the dailies is around 6,100 and then 5,900. This is the 20-day, the red line. The blue line is the 50-day moving average, and then the 200-day. So support is somewhere around 100 points to 200 points below the market. On the weeklies, we're looking at 5,800 as the support, which is the 50-week moving average. So I think we're fully priced here, and we get some kind of back and forth, up and down. Not something, unless something comes out of left field, pushes the market down dramatically. NASDAQ, same thing, third wave. We should see a fourth wave down. Support is about 20,000, then about 19,000. We're about 20 and a half plus or minus today. So 400 to 1,000 point pullback wouldn't be surprising in the NASDAQ. Also, weeklies, again, 21,000 to 21,500 was the target for the fifth wave. That is the Fibonacci projection from the third wave. We got up to about 21 and change, close to, we got to 20,000 and change, not 21. But it looks again like a fifth wave. So support 19,000 and 18.5. Those are the two numbers I'm looking at. 10 years still in this range, about 4.5% to about 4%, and just going back and forth, back and forth. And now we went down to about 4.2. Now we're up to about 4.4 today. So just in the range, nothing dramatic with interest rates going on. Gold also going sideways, going sort of between 3,200 and 34.5. We're at 33.5 today. Support 33.64, 33.30. Again, we could see another run up in the market if we see some kind of volatility. Still target coming in around 3,600. But we're in the fourth wave. Fourth waves, this is the fourth wave, are back and choppy, as I just said, looking at that. Oil went up dramatically, hit 78 when the Iran tensions were at high, came back all the way to 64. We're about $68 a barrel today. 68.50 is the 200-day moving average. Technically, not a lot, but seems like we are fully priced in the market. Now we need some time to digest the tremendous gains that we've seen since April. We could go back and forth a little bit for a period of time before we get more news. Interest rate cuts, they were expecting 2 interest rate cuts later on this year. So if you get, once we get past the July, then we're looking at the next meeting, and that could be what could be the stimulus, but we're still a couple of months away from that. So I think now is the time to really look at your portfolio, see where you are. You're at an all-time high, close to it. This is where you rebalance, make sure you have the right balance in your portfolio. If you need help, call us at 800-388-9700 or send me an email at invest@compact.com. And don't forget to subscribe to this channel. If you want to listen to the podcast, go to the Apple Store, download Market Wrap with Mo. And sorry, that's one word, Market Wrap with Mo. And sorry, you'll get the app, download it. You can listen to the podcast anytime. Now, those are my thoughts. Those are my observations. I will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compact Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compact Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that over-focus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.